Oh, good afternoon, and thank you very much indeed for joining us. I'm Stuart Thomas, a Senior Business Advisor at the Cambridge and Peterborough Combined Authorities Growth Hub. This is the 9th in a series of 11 EU exit webinars in partnership with ourselves, SEMLEP, OXLEP, New Anglia and BFF Growth Hubs aimed at helping businesses with international transition period, post-EU transition period, sorry. Our speaker today is Andrea Collins from the Export Department. Andrea is an international trade specialist with over 24 years in the industry. Andrea is fluent in French and Spanish and specialises in importing, exporting, Brexit preparedness, business resilience and business growth. She is a business development specialist, having worked in the chemicals, IT and professional services sectors, including holding senior roles within FTSE, NASDAQ and Euronext companies, including ICI and Right Now. A passionate ambassador of UK micro businesses and SMEs, Andrea launched the Export Department to assist these companies expand their horizons internationally and raise the profile of UK goods and services abroad. As well as supporting private clients with their international trade endeavours, Andrea delivers support for a number of growth hubs nationwide and is responsible for the design and delivery of a range of EU exit, international expansion and business resilience support programs. An MBA graduate, Andrea is also a trainer for the Institute of Export and International Trade. Today, Andrea is going to look at how exporters can minimise the risk of not getting paid when trading with overseas markets. Now, during the seminar, if you have any questions, please put them in the chat box. So thank you, and now please welcome today's speaker, Andrea Collins.
Hi everyone, let me just share my screen with you. Bear with me just 2 seconds. Hopefully, it's my presentation. Hopefully everybody can see that. So yes, today we're going to be talking about, we're moving on a little bit from Brexit, which is back into my home territory. I feel like I've lived and breathed Brexit for 4+ years, but it's important at some point that we kind of move on. We accept that it's happened and that we adjust to the new way of trading with the EU. And lots of people ask me, you know, if I see any benefit from Brexit. I was an ardent Remainer, and I appreciate their polarised views on this, but I didn't want us to leave. But I'm quite a pragmatist and I accept that we have left. And it's a case of making the most of it. And I think the one benefit that may come out of it in the longer term is we start to upskill in terms of our export abilities, because we have there are lots of companies in the UK who have traded very successfully exclusively within the EU and not necessarily exported. So actually Brexit forces us to upskill in the areas of import and export. And that might just mean in the longer term that those kind of high growth, what might be perceived as riskier markets become less challenging or less daunting for us. So, you know, some of the emerging markets and developing economies are seeing astronomical GDP growth, but prior to COVID, obviously everybody's been impacted by COVID. Whereas in the EU and the UK, that GDP is stagnating around 1 to 2%. There are some phenomenally exciting markets beyond the EU, and the US seems to be a default market for a lot of UK exporters as well. But there's other markets that have a real appetite for our products and our services, but they can be perceived as more risky than those developed economies. So really, when you're exporting, I can't underestimate the requirement to plan and assess risk before you move into a new market. And that's what I'm going to be covering today. So not just, you know, managing financial risk, but also managing risk as a whole and what to be looking at when you're assessing the suitability of new markets. And then we'll also cover, you know, getting paid and the various different mechanisms that you have open to you. So as I say, we're going to be talking, I've just pulled together a brief agenda. So I'm going to be citing what some exporters say in terms of what they believe the benefits are of exporting, and some of you are already exporting. Some of these will resonate with you. And then also talking about some of the things that tend to hold companies back from making that leap. We'll talk a little bit about the risks. We'll cover off making sure you get paid. So we'll talk about some of those different payment options that, you know, the risk that they bear to you, the exporter, and then to your customers, the importer. And then we'll talk a little bit about planning for that overseas expansion and what things to look for within a market. And then we'll cover off the all important contracts and T's and C's. The additional sources of support and information, any of you that have attended the Brexit webinars will know there's about 3 pages of various different links that I refer to throughout the presentations. But for the purpose of this one, obviously, we're moving beyond Brexit and we're looking at export. So there's a lot of new links and different sources of support. Okay. So in terms of what exporters say, in terms of the benefits, obviously it dramatically expands your customer base. You know, you can be very successful in your domestic market, but at some point your sales will plateau. It expands your customer base by moving into other markets. So that obviously has a direct impact on your revenues and your profitable growth. You've also got the opportunity to have more consistent revenue. So if you imagine some businesses have seasonal revenue in the UK, and obviously we have seasonal differences across the globe. So it allows you to perhaps in the down seasons in the UK, that can be supplemented by different climates across the world, if you like. Obviously diversification and adaptation, you move into new markets, it challenges you in terms of your innovation and how you need to diversify. You're faced with different competitors, be they local or be they international, and you're faced with different consumer and trade demands. So it forces you to kind of diversify and be creative about your offering. Reduces your dependency on the domestic market. So obviously, you know, there can be fluctuations in demand in your domestic market, and having those other markets to depend on obviously reduces your dependency. So if there's a you know, impacts on your domestic market, you're spreading the risk by having other revenue streams coming in from other countries. Innovation, I've kind of talked on. Longer product life cycles is quite important. So when I talked earlier about developing markets and emerging markets, if you think about it, you know, your product maybe plateauing within your domestic market, for example, but there might still be pent-up demand for that in other less developed economies. Economies of scale, obviously, export brings with it increased production capacity, it brings with it company growth, so therefore you benefit from economies of scale as you grow as an organization. And then increased competitive advantage, that ability to service those larger organizations that might have global installations. You have a presence in some of those countries, or you have distribution in those countries as well, so you become a little bit stickier with some of those larger clients. So there's some of the things that exporters will say in terms of the benefits, but in terms of you know, what puts them off making that leap. So obviously with Brexit, we've seen huge fluctuations in sterling, so you know, you can be caught off by currency fluctuations. Documentation, understanding import and export documentation and the kind of documentation that needs to accompany those declarations, which we've covered off in other sessions as well. Access to cash and funding. So export is typically a longer term game. The returns aren't always as immediate as you would see them in your domestic market, and companies can be concerned over whether or not they've got the cash or the funding to kind of stay in it with for the long term. Extended delivery obviously is another one, an extended payment term. So sometimes we'll cover some of this off as we go through, but extended payment terms can open up exporters to risk that they just don't want to bear. And in terms of extended delivery, that can be linked to payment terms as well. But also, if one of your USPs is getting your goods to your customers faster than anybody else can, that USP might not translate in the export market unless you've got a local presence there or you've got a partner or some kind of JV. Local culture and legislation is another one, and especially with those emerging markets, that exporters feel they're just a little bit beyond our understanding, whereby it's very easy to trade with the EU. They're very close to us culturally, the US to a certain extent as well. But those countries where they have different cultures, different preferences, there's also the language barrier, they can just seem to be a little bit unsurmountable for exporters and can put them off. And it's such a shame, because those countries hold huge promise for UK products and services. Country risks, political and economical, absolutely. Anybody that's familiar with PEST as an analysis tool will know that sometimes there are threats that are just beyond your control, and all you can do is, as I said, plan and make sure that you have risk mitigation strategies in to counter those, or you do your analysis up front and you decide, what, those economies just look like they're a little bit too risky for us at this moment. And then bad debts. So one of the major risks that exporters cite is not getting paid, and hopefully we'll cover off some of your concerns around that today. But bad debts is often cited as being something that obviously it has a massive impact on cash flow and is perceived to be a major risk for exporters. Okay, so that's really what exporters are saying. In terms of analysing the risk, so when you're embarking on a new market, there are a number of things that you need to be aware of in that market, and a number of things that you need to be looking at and preparing for. And I've really broken them down here into some of the key ones. So, you're assessing the country and the political landscape, you're assessing the commercial risk, you're looking at the local regulation and what that means in terms of risks and whether you can actually sell your products and services in that market, or are the regulatory burdens just too great? You're looking at the ethical considerations as well. And this is a really interesting one, and quite often one that exporters will overlook, but we'll cover that off in a separate slide. Obviously, intellectual property, your IP is a huge asset. You could say that there is more risk. When you export, there's more risks to your IP. But again, with everything with export, wherever the risk is, there's a way of mitigating it, and it should not prevent you from making that leap into that new market. I've been in export for 25 years now, and it is the most exhilarating, thrilling career ever. And it's also very, very lucrative for companies when they plan accordingly and they adapt their product and service to meet those market needs. There's also risks around cargo and shipping, obviously just relating to product exports, not services. Currency, which I touched on slightly before in terms of fluctuations and so on. And then credit as well, which kind of links to what I'm saying about there's extended credit terms, which exporters can quite often find themselves under extreme pressure in new markets to offer extended credit terms that place them at immeasurable risk, but they feel pressured because of what competition are doing, or because of the purchasing power of their customers. Okay, so we're just going to go through some of these individually. So if you think about country and political risk, so these would be kind of non-tariff trade barriers. So there might be, central bank exchange regulations. There might be bans on the sale of certain products in certain countries. So several countries like the EU and the UK have banned products obtained by from threatened animal species, for example. There's always going to be things that are beyond your control, such as sanctions, and you have to be prepared to overcome them. So as with sanctions and embargoes, as we've talked in previous presentations, all of the information around those restrictions is found in the UK trade tariff against your commodity code, so you can quite easily see where you can ship to, and similarly on the import side where you can bring in goods from, or similarly you can check with the Ministry of Foreign Affairs and Trade in that specific country for further clarification. You've also got what I would refer to as exchange control regulations. So several developing nations operate certain exchange control regulations that are associated with the flow of money from and to their country. So you need to identify if there are those regulations, if they're effective in that country, because these can kind of delay your payments. And then we've got the notion of prohibited goods, which we've talked a lot about over the, just before Christmas when we were talking about licensing requirements and so on. So you really need to make sure that you can actually export your goods to some of these nations. So, what products that might be acceptable in China, for example, might not be allowed in New Zealand. So you need to check out the rules pertaining to your target market in that country that you're interested in exporting to. And obviously, whenever you're exporting, we've talked a lot about this with Brexit because we're exporting to the EU now, there will be certain circumstances where you have to have those products verified so that they can meet the requirements in that country. So sometimes licensing or certification might be required. And I think the takeaway here is it might seem a little bit onerous to go through some of this, but it's better to be familiar with all of the rules that govern your product in that market rather than facing hurdles at a later stage. Okay, and things like political instability. Obviously, there's a really good Santander do a really good trade portal that provides that the information isn't totally up to date, but it gives you quite a good overview of that kind of political and economic landscape of individual countries. So it's really quite good. I think there's something like a 90-day free trial, and then it's a subscription model after that. But it's that kind of data that you need to be accessing in order to determine that country and political risk. In terms of commercial risk, so obviously, commercial risks exist in our domestic market too. There's always risk in trade, even here in the UK. But obviously, the impact in the international market is going to be greater. And those changes in terms of the international market can be more difficult to anticipate. Okay, so you've also got the situation whereby the suitability and acceptability of the product in international markets is going to be difficult to gauge. And then also variations in demand and supply conditions are a little bit more unpredictable. So there's lots of different things that can impact your commercial risk in an export market. But most, and I think when you think about it, when you analyze the risks, most of them are borne by you, the exporter, which is why it can be a little bit off-putting. You've also got, as in the domestic market, you've got the presence of competitors, and you'll have both local competitors and international competitors in those markets. And we've talked a lot over recent weeks about preferential landscape and how Brexit has removed much of our preferential landscape across the world, and it's going to take the UK government some time to rebuild that back up. So I suppose as exporters, we might be moving into markets whereby there'll be other international suppliers who have preferential agreements with that market, whereby the UK hasn't managed to strike one yet. So that obviously has an impact on how you price your products and perhaps your margin as well, and how competitive you are in that market. Obviously, local production is going to bring down the prices, but that doesn't mean to say that it needs to be a race to the bottom. The UK has a very good global reputation for good quality products and services, and there's empirical research, especially in those emerging markets, that show that companies are willing to pay a price premium for those products that are made in GB because they have that perception of value, of quality, if you like. There's also the risk of government intervention. So we've talked in the past about tariffs and the whole purpose of tariffs. So governments have at their disposal the ability to impose or lower tariffs to either boost or protect an economy. And they will do this. And obviously, if you're already in that market or you're looking to break into that market, those tariffs will have an impact on how easy it is for you to enter that market. I've listed here a couple of the most commonly cited concerns by exporters. But if you think about it, as I said before, any risk can always be mitigated, and commercial risks can be minimise by, you know, really good forecasting, really having your finger on the button in terms of forecasting yourselves into that market, and keeping a really careful watch on that changing business condition and changes in the world economy as well. And as I said, you cannot underestimate the requirement to research and plan, and that research and that planning shouldn't be something that you just do to break into a market. It should be continuous. Okay, you need to, especially now in the post-Brexit era, UK companies really need to define their value add, and they need to differentiate on the basis of quality and customer experience, and be able to define where we sit in relation to other local and international competitors. That's paramount now, because especially if we look at the EU, we've become a little bit more difficult to deal with now. So we really need to up our game. Okay. Regulatory risk, regulation I class as non-tariff barriers, but they are significant. And actually, when we've been asked over the last 4.5 years what we thought were going to be the greatest risks of Brexit for small companies, we cited regulation. Tariffs, not so much. Tariffs do have an impact, but regulation and deviating from, so say, for example, the risk of the UK deviating from the EU regulation over the long term poses a risk to exporters and importers alike. So regulation can't be underestimated. So things like, you know, I've listed some here, changes to requirements to clear customs, for example, any changes to product and packaging regulations. So Germany is particularly stringent on its recycling packaging and so on, and obviously you have to meet those requirements in order to export into that country. So that can have an impact on your bottom line, really. And then government procurement restrictions. You know, we've all kind of marveled at President Trump's, some of the stuff that he's tried to achieve in his time in the White House, and very much had a protectionist approach to global trade, if you like, and you know, that has an impact on our ability to trade with the US, and we see this across the globe, really. But I've listed some of the most common ones here as well, and it's important to cite those kind of regulations like employment and consumer rights and protections. Consumer rights and protection particularly is a big one when we're selling consumer products, and you know, are we sure that our procedures and processes are in place to be able to adhere to that regulation? Okay, so regulatory risk is one, and again, it's just about being forewarned and forearmed and making sure that you've done your research in order to prepare optimally. Ethical risk, like I said, is one of the ones that is often overlooked by exporters, and it really can have, if you enter a market like a bull in a china shop without considering it, you're going to come a cropper at some point. So it's really important that you understand your company's mission, vision, goals, policies, strategies for that international expansion, and make sure that they fit with the country that you're moving into. So you need to take account of those legal and ethical issues when you're looking at countries. So you're going to be having to tackle those moral and ethical challenges and decision making in order to make your entry into that market a success. So most common ethical issues I've listed here, and if you imagine businesses trading internationally are expected to fully comply with you know, all of these kind of regulations, all kind of state safety regulations, environmental laws, fiscal and monetary reporting statutes, and civil rights laws, and so on. Cultural considerations can also make or break a company conducting business globally, and there are some very famously cited examples of some of the really big brands making mistakes when breaking into new markets and not really fully understanding the culture and how their brand is translated in that local market. So it shows even the big boys can make mistakes. Obviously, every culture and every nation has its own history, it has its own customs, traditions, code of ethics, and so on. And then those cultural barriers, as I mentioned earlier, include language. So often means that you know, you as an exporter, you might have to rely on translators when speaking to business contacts and customers, it might mean that you have to transcreate your messaging in order to appeal from a marketing perspective in that country. You know, when we in the UK have this perception that everybody speaks English, and yes, English is a widely used business language across the globe, but when customers are buying, they want to buy in their own language, they want to be marketed to in their own language, and it's not just a case of translating your messaging, it's about transcreating it, it's about speaking to them in their own colloquialisms and so on, and that's a really big takeaway. When I have clients say to me, oh, I've got Google Translate, I just shudder shudder in terror. Gender can also be an issue in some countries where women don't have the same rights as men. Religious holidays and other cultural events can prohibit trade at certain times. And you've really got to make sure that you act in accordance with those ethical and cultural values if you're going to win clients and gain that competitive advantage in that particular market. So those ethical risks, those cultural values are really, really important. And then intellectual property risks. I am not an IP specialist, I don't profess to be, and you should also always seek advice from the IPO, the Intellectual Property Office, or an IP specialist. But I'm just listing here a couple of things to think about. So exclusivity, you know, that's concerning your right to prevent others from using and benefiting from your creation, from your product or your service. IP rights are territorial, so those IP protections, they're only valid in the country or region where they've been granted. So you might have to manage several registrations, and we're seeing that with the UK and EU rights with Brexit now. So, you know, those EU registered rights have now been kind of grandfathered over to the UK, but UK companies are now having to manage two sets of IP rights, whereas previously it was just one. You need to make sure that you have the freedom to operate in that country. So can your company actually develop, make and market products without legal liabilities to third parties? So other patent holders, for example. You have to respect the deadline. So once you've made an application for a patent or a design, and that's been made domestically, then you have to make your international application within what we call the priority period. So for patents, that's within 12 months, and for designs, it's within 6 months. If you're working with partners, you need to really clearly define IP ownership. So if you're developing a new product with a partner, or establishing a JV, or modifying design or anything, have that agreement in writing, clearly understand who owns the IP. And then in terms of choosing trademarks, and this goes back to what I was saying about some of the big brands earlier, does that trademark have any undesired connotations, or could it be rejected in that country? So, and when you're looking at things like that, don't just think about the wording. It's not just about the wording and the language, it's about the colours and the imagery. Certain images and colours can incite different perceptions in export markets, and it's really, really important that you understand that. And then auditing. So it's really important that you conduct regular audits of your IP. So identifying what IP you've got, whether they're maintained, are they being exploited optimally, are any of them redundant, and has there been any infringement, for example. So again, not an IP specialist, but thought it was quite important to put that down for something for you to consider. In terms of exporting goods, so again, not exporting services, just goods, cargo can present a bit of a risk, and again, you just need to be prepared for it. So I would say that transportation has undergone radical improvements over the last few years. We've got global trusted trader schemes, like here in the UK, we've got authorised economic operator. You might have heard me refer in previous presentations to AEO, and that part of that focuses on the safety and security of the supply chain. So that's made huge advancements in terms of minimising that risk. Most goods are transported by sea, and obviously the transit risks for those kind of goods. You've got storms, collisions, theft, leakage, explosions, spoilage, fire, high sea robbery. Not sure that happens quite so often. But every exporter needs to have a working knowledge of marine insurance to know whether they're getting the required risk protection at the minimum cost. Okay, and that the principles of marine insurance are also equally applicable to insurance of air cargo, but you need to understand your insurance cover to mitigate against those cargo risks. Currency risk. So this is kind of linked to a country's economic stability. So high levels of government debt can obviously lead to inflation and currency destabilization, both of which are going to have a real significant impact on any company doing business in or with a particular country. So it's really important that you have an appropriate exchange policy in place, because that helps stabilize margins, mitigate the negative impact of fluctuating rates on those sales, and if you're importing on those procurements. Obviously it enhances cash flow, and it simplifies that foreign pricing, if you like. An exporter's bank, your bank, would be able to help with that kind of support around this. I mean, there's various different mechanisms. You can look at hedging as a means of reducing the impact of further sterling volatility and protecting those cash flows. Like I say, we've seen a lot of it with Brexit. You know, to give an example of your exposure, say you import goods from the US and the pound drops 10% against the dollar, your costs go up by 10%. So those fluctuations impact on cash flow and margin. And on the export side of things, where there's a gap between an order being paid and payment being made, if you like, then there's a significant exchange rate fluctuation. Your payment amount takes a hit. So again, it has an impact on cash flow and margin. There are other options open to you. So, you know, I've listed a few of them here. So you can have a foreign bank account. So you can look to transfer funds to the UK when the exchange rate's more favourable. You can have futures contracts. And then currency options. So, you know, the opportunity to buy or sell a set amount of currency at a set price or on or before a chosen date. So there's lots of different ways to mitigate against your currency risk. But again, your bank is going to be best positioned to advise on that. In terms of credit risk, so I've listed some of them here, and they are considerations for exporters. And like I say, that risk of not being paid is always cited as one of the inhibitors to export. But if you think about it, risk can arise due to the inability of your customer or the buyer to pay on the due date. Or say the buyer makes the payment, situations might change in the export country or the destination country that mean that the funds of the buyer haven't reached you, the exporter, on time. Whatever the reason be is, obviously exporters quite rightly feel that they're quite exposed. Now there are credit risk insurance, which can be immense help, as well as banks that finance exporters, and some of the names that you may be familiar with are the likes of UK Export Finance, a government based scheme, if you like, and then also BB Financial Services are particularly helpful to those kind of micros and lower to mid-tier SMEs as well. Okay, so lots of different ways to minimize your credit risk. In terms of making sure you get paid, I love this diagram. It's the payment risk diagram, and it kind of has, what's the word I want to look for? Spectrum, if you like. So it shows the different methods of payment and where they're most secure to the exporter and least secure to the exporter, and so on, and the importer. And so there's lots of different ways of arranging export payment, and we're going to go through some of these now. Okay, so cash in advance. Obviously, this kind of payment term helps you, the exporter, avoid all credit risks. So you receive your payment up front before the title of the goods is transferred, if you like. So with international sales, we see wire transfers, we see credit cards. They're the most commonly used cash in advance options available for importers when they're buying goods in from the UK under cash in advance. So this presents the least risk to you, the seller or the exporter, but it's the most risk to the buyer. So obviously, if you're requiring payment in advance, it's going to be the least favourable option for your customer, because it generates unfavourable cash flow for them. Okay, so it's quite often used when traders don't know each other very well, and perhaps the credit worthiness of the buyer hasn't been able to be ascertained. So maybe, you know, that we see that in some emerging markets where perhaps they don't have the same kind of credit analysis schemes as we do in the developed world. But exporters that insist on cash in advance as their only manner of doing business are in the long term going to lose business to competitors, because competitors will be looking to offer more attractive payment terms. You have to be mindful of that. It's not uncommon to see cash in advance for the first shipment, or maybe the first 3 shipments, but then most importers will want to move to some form of alternative that minimises their risk. And we move on to documentary collection. So this is where the seller, so you, the exporter, you forward documents related to the export of the goods to your customer's bank with an instruction to present those documents to the buyer for payment. And then you kind of point to when and on what circumstances those documents can be released. So if you think about it, under documentary collections, you've got funds are received from the importer and transferred to the exporter. So you're using the banks as facilitators here, really. So the banks are involved in the collection and the exchange of those documents. As I say, the banks operate as facilitators for clients, so for you, the exporter, and for the importer. But documentary collections offer no verification process, and there's really limited recourse in the event of non-payment. So they don't offer the same level of security as letters of credit. But as a result of that, the costs of arranging documentary collections are lower than letters of credit. When the bank that's received the documentary collection debits the buyer's account and makes the payment only if authorized by the buyer again. So there isn't that kind of automated, again, the buyer has to authorize the release of those funds, if you like. So it's not a letter of credit, it is different. Moving on to letters of credit. So this is probably one of the most secure methods of payment available in international trade. So it's essentially a letter from a bank guaranteeing that if the buyer's payment to a seller will be received on time and for the correct amount. So it gives utmost security to the exporter, to you, the exporter. So the buyer would set up the credit and pay their bank for that service. So they kind of bear the costs. Again, it's quite useful where that well-founded credit information about the importer doesn't exist, or it's been difficult to secure. But you as the exporter are satisfied with the creditworthiness of the importer's bank. And then the letter of credit also protects the buyer, because they don't need to actually make the payment until the goods have been shipped as promised. So it kind of protects both parties in that respect, but obviously there is a cost, and that's typically borne by the importer. So that's letter of credit. And then finally, open account. So that's where the goods are shipped and delivered before payments due. Okay, so in international trade, we see anything from 30 to 60 to 90 days. Obviously, that method of payment has to be based on the trustworthiness between the two parties, and that's one of the most advantageous options to the importer in terms of cash flow and cost. But consequently, it's one of the most highest risk options for an exporter. Because of the high risk of competition in export markets, foreign buyers, as I said earlier, are often pressed to offer open account terms, and may be reluctant to do so in the early stages of a relationship. But if they don't move towards open account over time, they do run the risk of potentially losing sales to their competitors. Okay. Moving on, consignment is another method. So consignment is like another method of open account, which if you imagine payments sent to the exporter only after the goods are sold by the foreign distributor or importer. So you'd ship your goods to your to your customer, and you'd receive payment when they had sold the goods on to their customers. It's based on a contractual arrangement where, as I say, your importer or your customer receives and manages and sells the goods for you, the exporter. Now, you retain title to the goods until they're sold. So there is you retain title to the goods even though they might be in the destination country. It does have risks for the exporter, obviously, because there's a lot can happen, both on the political and economic landscape between you shipping the goods and you receiving payment from them or from your importer. But it does increase your competitiveness, if you like, in those local markets, because you have ready availability of product and faster delivery of goods. So there are some benefits as well. It can also reduce your costs in terms of your storing and managing inventory here in the domestic market. And I think the key to consignment supply, where we've seen it work really well, is where you partner with a reputable and trustworthy foreign importer or distributor, or a third-party logistics provider. So there has to be that trust, and there has to be that creditworthiness, and it has to work for both parties. And you should always look to have insurance to cover those goods in transit or while they're in the possession of that foreign distributor or importer as well, just purely to mitigate against the risk of non-payment. But consignment's another method. So when we're this is what I love. I've missed export with dealing with Brexit for so long, but when we are dealing with export, and like I say, it's so thrilling, it can be so lucrative, it can be so rewarding, but there is a process that you have to go through as exporters to make sure that you've covered all your bases. So I typically cover off these kind of areas and put things into these boxes. So if you think about business readiness, it's really important to know whether you're geared up for export. So understand your motivations for exporting. Understand your branding. Does it translate to the market that you want to move into? Understand your product readiness for export. Is it versatile? Can it be easily differentiated? Are there any potential compliance issues? And then you need to understand your capacity in-house. So what are your available in-house skills, knowledge, resources? Export can be quite resource intensive when you start, and you need to make sure that if you don't have those skills in-house, where can you easily access to them? And there's a wealth of knowledge and expertise out there around international trade. Understand your existing processes and how they need to be adapted when you start exporting. Or, you know, if you're already exporting, just because you export into one country doesn't mean to say that you can necessarily replicate what you do when you break into another market. Sometimes it feels like you're starting again, but you're using the same process to prepare. So you're learning as you go through. And then understand your competitiveness. So what is your competitiveness like in your domestic market? Is it going to be the same? As I mentioned earlier, what are your USPs in the domestic market? Can they be easily translated? Or do you lose some USPs because you're, you know, perfect example what I said earlier about your time to get products to customers. Do you lose that USP, and in which case, what can you replace it with, if you like? So understand your competitiveness, understand your USPs. Understand your capacity to fulfill those overseas demands. So is it via existing inventory? Is it via other sources? And then really understand your financial situation. So have you got the funds to invest in those kind of upfront costs, in that management of cash flow? You know, can you mitigate against your sensitivity with regard to exchange rate fluctuations and payment and so on? And I can't stress enough, export can be so lucrative, but it is a longer term game. And as I say, the returns aren't always as immediate as you would see in the domestic market, but when they start to come through, it can really transform your business. Market research. So can't underestimate the importance of market research, and we've covered some of the areas that you should be looking at around, you know, mitigating that risk. So what's the potential for your product or service in the target market? So you know, looking at GDP per capita, looking at disposable income, can all help indicate, you know, potential spending power. So in the emerging markets that I referred to earlier, we're seeing the emergence of this quite strong middle class with disposable income, with an appetite for UK products and goods, can you tap into that? Is your product or market niche? How do you research that market? You know, what are your, how do you reach that market? What are going to be your routes to market? What are the legal and regulatory requirements within those target markets? And we touched on some of those earlier. How big's the sector in the industry? Is it buoyant? You know, just because a sector is mature in an export market doesn't mean to say that you shouldn't be going into it. But you just need to understand the limitations and the considerations there. How stable is the market? So we talked about that political and economic considerations. Are there any cultural considerations to selling in that market, which we've covered off a little bit about? What is the customer demographic? So are they all similar characteristics to your domestic customers? What competition's there? You know, are some of your domestic competitors there? Are some of the competitors that you come across there, are you up against local competitors? Are you coming up against international competitors? And then again, going back to the previous slide, how do you kind of differentiate your offering? How do you convey your value add, if you like? And other things, you know, you might want to look at what trade fairs or exhibitions, obviously post-COVID, that are going to be there. They can pose a brilliant opportunity in terms of doing that feet on the ground market research, where you can go and you get the opportunity to meet up with potential distributors, agents and so on, and also get a feel for other players, movers and shakers in the market. So they can be a great source of feet on the ground research that just enhances your desktop research, if you like. Understand what support and advice is available. So DIT is a good source of advice, obviously ourselves, the export department, your local chambers. DIT produce some fantastic country guides. There are some fantastic market reports out there, lots of trade bodies, trade shows, online marketplaces where you can dip your toes into those markets without actually, you know, fully taking on export, if you like. You can gauge what the demand is for your product. Risk analysis, obviously that's been subject of this presentation, but I can't underestimate the importance of that. And then in terms of your strategy and planning, so we break this down with clients in terms of manageable chunks. So, you know, determine your objectives. What are you hoping to achieve in terms of sales, in terms of turnover, in terms of profitability? What's your route to market? You know, are you looking at direct? Are you looking at distributors and agents? Are you looking at a franchising or a licensing model? Are you looking to set up an overseas office? Are you looking to go down the e-commerce route? Look at how you're going to finance it. So are you going to use some of the various different support options out there, like UK Export Finance? Do you need to take on investment to actually expand overseas? How are you going to finance this move? And that could be, you know, you're already exporting, but you're moving into new markets. So you could be a novice exporter and this is all new to you. Understand your risk mitigation strategy. So how are you going to secure payment? How are you going to cover off those exchange rate fluctuations? How are you going to obtain those credit references? What does credit insurance look like? And again, all of that stuff around political change, economic instability, sometimes poor transport infrastructure, not forgetting some of these really exciting emerging markets don't have the transport infrastructure in place that we take for granted here in the developed economies. So you have to take in all of these things into account. Acquiring and developing the required skills. So, you know, are you going to train internally, or are you going to recruit for people that can already help you develop your markets overseas? Think about your intellectual property. So those kind of IP rules and regimes vary significantly around the world. And as I said earlier, just because IP rights have been granted in one jurisdiction it only provides cover within that jurisdiction. So, you know, you need to think about your IP and think about how protecting it. Think about if your portfolio, if your product requires post-sale support and service, how are you going to provide that? prepare for any what we call legal implications your product might have. So things that we've mentioned in previous webinars, so around export licensing, around certification, making sure that safety and labeling requirements are adhered to. Understand the tax position of your goods. You know, we're finding that VAT is certainly posing a lot of problems in the post-Brexit era. So understand what your responsibilities are with regard to the tax position of your goods. Establish your export pricing that reflects those additional costs and those risks of exporting. So, you know, we've talked last week, I think it was, around Incoterms and how they impose certain obligations on you as the exporter. What costs do you incur as a result of taking on those responsibilities? If you require additional packaging to break into that market, how does that impact on your costs and your margin? So your export pricing has to reflect all of those additional costs, whilst at the same time being competitive in the target market. So it's a delicate balancing act to be struck where you're moving into a market where you don't have first mover advantage, for example, where there's already existing competition. And then really, really important, establish your export budget. So be clear about how initial expenses are going to be allocated and when you expect to receive a return, and monitor that continuously, really. Route to market, we talk to clients about a lot. So what is your route to market? Is it having a market presence? Is it e-commerce? Are you going to go down the indirect routes, so distribution, resellers, agents, and so on? And then in terms of market entry preparation, we come back round again to intellectual property, looking at trademarks, designs, patents, copyright. Think about the translation of marketing collateral, translation of packaging, labeling, so all that stuff around product data sheets, health and safety data. We get back into the realms of transcreation, so not just translation of your online presence, but transcreation. So how do you look like you are a local company? So, you know, what is the messaging like on your website, on your social media, and so on? And understanding that social media platforms that we use in the UK, albeit Facebook has global dominance basically, but there are other platforms that are used. You know, in China, for example, WeChat dominates as social media, as a messaging platform and everything. So what are the social media platforms that are most prevalent in your target market? Think about your contracts and agreements. So you know, if you are using distribution or an agent, for example, they need to be really quite robust. And similarly with customers, we talked a little bit about insurance, be that credit or cargo. Think about your payment terms. What are you willing to accept? And, you know, is there a transition to those payment terms? So you're going to insist on cash up front, but then, you know, providing everything goes according to plan, you're going to open a line of credit and so on. Think about payment methods that you're willing to accept. So certain payment methods can attract costs and you need to build that in. SWIFT is probably, you know, a universally understood payment method. And then determine methods of payment. So shipment, sorry. So where you're dealing with the movement of goods, you know, is that going to be through fast parcel operators? Are you going to be using freight forwarders, and so on? And do you have clearance agents in place? And then really important, understand what the regulatory requirements and the customs clearance requirements are for your goods. So are there any requirements for licenses or statements of origin or certification, for example? All of these things fall into that market preparation piece. In terms of assessing economic risk, and I'm really conscious of time here, so you will get a copy of the slides. I did think I'd finish under 3 o'clock. I never seem to. There are hundreds of factors to consider in international business when you're looking to embark on a new opportunity. And if you think about how these are categorized, you've got economic risks, so they stem from a country's financial condition and ability to repay debts. Then you've got political risks, and that comes from the impact of politicians' decisions about investments. And then you've got social and structural factors to consider. So they're factors that are unique to a country, like belief systems and practices and customs, traditions, behaviors, all of those lovely things, trends and influences. Obviously, tax laws, interest rate hikes, political and social unrest or upheaval, even comments from politicians can impact international business dealings. So, like I said earlier, if you look at the 4 years of Trump presidency and that protectionist policy and some of the kind of language that came out from the White House during his tenure. But then there's specific risks that I've included on this slide here. I won't go into too much detail, because I do want to finish and take questions at the end. But you really do have to evaluate a country's economic data to determine the risk that it poses to you before you enter. I don't want to labour it too much. It sounds like an awful lot of work. It really isn't. And there's lots of information out there, but it just pays to do that research, because even the most developed economies can have economic consequences. If you just look at Brexit for the UK, for example, and then COVID that's impacted the globe. So, there are things that happen that are beyond our control, but if you are kind of preempting what they may be, then you can put in, risk mitigation strategies. Sorry, I can't talk today. Assessing political risk. So from the most developed to the least developed nations, there's always going to be some level of political risk, and you always have to look into factors like the stability at all levels of government, the presence of any corruption, what the regulatory requirements like, and so on. Obviously, signs of instability, if you look at what's happening on the global stage at the minute in terms of coup d'etat and so on. If you're looking at a market that there has been some kind of military move like that, then that probably translates as a significant political risk, and you do wise to steer clear until things settle down. But also changes in government policies and priorities following election and leadership change can have significant influence. Again, I hate to keep going back to Trump, but the US international landscape or attitude to intellectual trade changed dramatically between Obama's tenure and Trump. So now we look like we'll go back under the Biden presidency to a more open global trade approach from what were Trump's quite protectionist policies. Obviously, a shift from less to more regulation or greater state ownership of certain industries, that can present political risk. And they're all things that you should be considering. I've listed some of them here, things that you might want to consider. And then structural risk. So there are always going to be structural and social factors within a specific country, and you need to give those close inspection. Those structural factors are any kind of fixed elements within a country that can impact economic performance, and I've listed some of them here again. So we've talked about social infrastructure, demographics, disposable income, competition, and so on and so forth. Rushing through here, other factors to consider. I love these two sources of information. So you've got Transparency International's Corruption Perception Index. This is it does exactly what it says on the tin. It ranks each country, most of the globe, in terms of how they rate in terms of their level of corruption. So obviously some of the more emerging markets have greater levels of corruption at customs, and there are penalties for UK companies that are seen to be falling foul of this corruption. So you can, I won't go into too much detail, but you need to understand when you're breaking into a new market how corrupt that market potentially could be, and how you safeguard your company and your staff when trading with that market. And then the other one is the World Bank Ease of Doing Business index, which is great as well. So that kind of rates each country across the globe according to how easy it is to penetrate that company, set up overseas, deal with that company, trade at that company. That's a really other good source of information. And then contracts, T's and C's, I promise this is the last slide. In as much as we've talked about insurance as mitigating risk and research and plan, having a really robust contract is really, really important as well, be that with a distributor, be that with a customer. So, you always have explicitly the details of the principal and the agent. You have very clear understanding of the products and services that are provided. Incoterms, obviously I've talked about this extensively over the last few months, how they become really important now when we're dealing with the EU. They should be explicitly stated in any T's and C's. Obviously payment terms and retention of title of the goods, any guarantees or waivers offered, Timelines for delivery, that's really important, and what flexibility there is on either side. Where there's breach of contract, or you know, either party wants to end the relationship. Sorry, I just spotted a typo on there. TO should be 2. Where either party wants to end, then the contract needs to explicitly state how they go about doing that, what the term of the agreement is. You know, are you offering, say, for example, a distributor exclusivity, in which case you might want to limit that to see how they perform in the market, because if they don't reach expectations, then you might want to, you know, remove their exclusivity and open it up to other partners in the region. So what's the terms of the agreement? How long is the agreement in force for? What's the notice period? And then really important, what's the jurisdiction governing the contract? So what's the law governing the contract? Okay. And then additional information and support, we're on to the final hurdle. Obviously, this differs very significantly from what we've been talking about over current months. It's not about Brexit. This is about looking beyond Brexit and thinking, how do we make the best of the situation we're in, and can we become a little bit more ambitious in our exporting endeavours, if you like. So I've provided a ton of information there that hopefully will be useful to you. And that really, Sam, I'm so sorry, I've done it again, but I have gone over my 3 o'clock.
It's all right, I don't think anybody minds with the level of detail that you give us every single week.
That's super. Do we have any questions?
I've got nothing in the chat at the moment, but if anyone is madly typing away, I'm happy to give it a minute or so for anyone that's got anything.
Hopefully I've just covered it off and people are, I mean, obviously they get the slides, so there's lots to refer back to. It's quite a lot to take in an hour, but my details are there. If anybody has a question, I'm quite happy to field that outside of the session.
I don't think there's anything coming through, so thank you very much once again.
You're very, very welcome. Thanks ever so much, everyone, for listening to me drone on for an hour. And I look forward to seeing you in 2 weeks' time, I think it is, Sam.
Yes, thank you very much. I'm just going to pop our details up now. And like I say, Andrea's details have just been on the screen, but if you missed them, then just get in touch with us and we can pass them on to you.